These are the lowest valuations we've seen in a long, long time on a lot of very high quality companies. So
if NNN matches growth expectation and returns to fair value, it could post 46% total returns by the end of 2026.
Netflix. I've been a hater of this company for a long time. I didn't like I like the business model. I didn't like the valuation.
It's a highly sustainable business model, probably one of the widest moats I've seen, in this kind of technology place.
Gold is my call for 2026. I know I'll be tempted to do it, but I really hope I avoid the temptation and just continue to buy blue chip stock.
Hello, everyone. It's Brad Thomas, and welcome back to the holiday edition of the Wide Moat Show. And today I've got Santa Claus with me, my co-host, Nicholas Ward.
Yeah, it's Christmas morning when this gets published. So I was playing Santa Claus last night. I'm sure I'll be very tired when I watch this in the morning, but that's okay. Wonderful time of the year. Very much looking forward to watching my kids, open up the presents under the tree, open up their stockings. And that's what I'm going to be talking about today, stocking stuffers. Something I like to receive in my stocking from a stock market perspective, and then some coal I would rather avoid. And then Brad, I think you've got a holiday angle on your picks for today's video as well, don't you?
Yeah, for years and years and years, I wrote a column when I was writing at Seeking Alpha in Forbes called "All I Want for Christmas Are a Few Good REITs." And so I'm going to keep delivering that same content here for the Wide Moat Show. First off, I wrote an article today on that same topic for the widemoatdaily.com. So please click on the widemoatdaily.com. You can see all of our free content. So I wrote this article recently, and I explained that over the last 15 years, REITs performed very well, especially coming out of the Great Recession. I'm going to show you this chart here that highlights the fact that REITs were the top performing asset class in 2010, 2011, 2012, 2014, 2015, and 2021. Now, in the other years, if we see more recently, REITs have suffered. But there's a reason for that. I just want to point this out really quick. It's extremely important to our thesis here at Wide Moat Research, especially regarding REITs. So after the crash in 2008, the Federal Reserve immediately slashed interest rates in order to encourage economic activity. And by December, the Fed had reduced the rates to a range of 0% to 0.25%. This was the start of this prolonged period of ultra low interest rates. And since REITs tend to thrive when interest rates are down, investors piled onto them. So when the Fed began to raise interest rates in December 2015, they increased the cost of capital, thereby reducing REITs' perceived attractiveness. Now, when I say perceived, think about that. Because contrary to popular opinion, these commercial real estate businesses can still grow in less opportune environments, raising the dividends while maintaining these solid balance sheets. So when the Fed raised rates even more in 2017, what happened? REITs underperformed yet again. In 2020, it was a different story. The pandemic and ensuing lockdowns shuttered real estate properties. So you can understand why investors fled from real estate and why it became that year's worst performing sector of that year. However, REITs rocketed back up the next year. They were the top asset class, bringing the stock market huge gains. Though that victory was really short-lived, as the Fed hiked interest rates a total of 11 times starting in 2022, and now you can see why REITs have fallen out of favor over the last 2 years. As I wrote recently in the Wide Moat Daily, I've witnessed over 3 decades of economic cycles, and I've never seen a time when REIT valuations were so attractive. They're boasting strong fundamentals, favorable supply trends, and capital markets that are wide open. Their share price is undervalued to the point of being ridiculous. Now, rate cuts are like rocket fuel for the REIT sector, and I anticipate 2026 to be a very good year for this asset class. So let's start with 2 REITs real quick. These are the 2 REITs I like. They're on my shopping list and should be stocking stuffers. First off is Extra Space. This is very large, the dominant largest player in the self-storage industry with 4,238 properties, over 326 million square feet. Now, one of the things I like about the storage industry in general is the high fragmentation that exists, and that creates an opportunity for consolidation. Extra Space has around a 14% market share within the US, what makes the company a prime time consolidator for both REITs, publicly traded, and non REIT owners. Extra Space also enjoys a technology advantage with its sophisticated pricing models that drives machine learning. The company utilizes the omni-channel to generate new customers and retention, as well as branding and data usage. The company has a strong balance sheet. They're BBB plus S&P, Baa2 with Moody's, 5.2 net debt to EBITDA, very conservative capital structure. In the last quarter, same store occupancy was 93.7% at the quarter end and averaged 94.1% during that quarter, a 30 basis points improvement year over year. And last quarter, the company said its high occupancy allowed the company to begin pushing new customer rates. And this trend has allowed the company to achieve new customer rate of growth of 3% year over year. In addition, Extra Space raised its full year FFO guidance to a range of $8.12 to $8.20 and updated its fourth quarter outlook. Now you can see here using fast graphs again, there's modest growth this year, about 1% based on AFFO per share. That's in 2025. And consensus estimates is around 3% growth in 2026, 2027. So we're not talking about a growth story here. We're talking about a valuation story. As you can see on the fast graph, shares are trading at 16.5 times, compared with the normal valuation of 21.6 times. Dividend yield is really nice, 5.1%. It's well covered. Payout ratio is just above 80%. So in my view, Extra Space is one of the best picks out there. I like the self-storage space. Management has done an excellent job of scaling this business model, generating steady earnings and dividends. And I believe the company could deliver returns of around 25% on an annualized basis. So now moving on to my next stocking stuffer is NNN REIT. This is a freestanding REIT, which means they own standalone properties. They have about 4,000 of these. And they select their tenants based on stronger performance, these companies that can survive and thrive in various different economic cycles. So they don't invest in office, industrial, or other types of uses. Primarily, it's retail. They focus on main street locations that provide a strong market for replacement tenants and rent growth. In addition, the retail operators are more likely to renew these leases at the initial term. Typical term is between 10 to 20-year lease terms. So these are very reliable, predictable tenants. The weighted average lease term for this portfolio is about 10.1 years. The company anticipates occupancy will exceed 98% by the end of 2025. This would be in line with 98.2% average recorded since 2005. The company remains very active in terms of acquisitions. They've got plenty of capital, $1.4 billion of liquidity on the balance sheet as of the third quarter of 2025. That includes capacity on its $1.2 billion revolver and nearly $160 million in cash. Now, the debt duration is also very solid, 10.7 years, which is really the highest in the net lease sector. Then this points to a very well staggered debt ladder. That's why this company, this REIT, NNN, enjoys a BBB plus S&P rating with a stable outlook. Now, in the last couple of months, shares have fallen by around 6%, inclusive of dividends. That's a contrast to the 2% total return posted by the S&P index over that time. I believe this divergence between fundamentals and sentiment has further strengthened the buy case for NNN. The stock price is 11.5 times compared with a normal valuation of 16.4 times. You can look at this fast graph here. The 3.1% annual core FFO per share growth consensus is comparable to CAGR generated in recent years. That points to the net lease REIT's growth potential holding up relatively well. Applying my fair value price to FFO ratio of 15.2 times, I compute a fair value of $53 a share. Relative to the current $40 share price, that's as of December 9, 2025, this equates to a 25% discount to fair value. If NNN matches growth expectation and returns to fair value, it could post 46% total returns by the end of 2026. Nick, I'm going to hand it over to you. I can't wait to hear your stocking stuffer. And I know you've got some coal for us today as well.
Yeah, no, those were great picks. And I'm glad you highlighted how REITs have done so well in the past, right? Like I'm sure we have a lot of viewers that wonder, why do Nick and Brad talk about REITs so much these stocks have just been crushed for the last 2 years. They've underperformed. These guys are idiots. Well, we're not. Companies have done very well in the past. It's just a tough kind of macro environment for real estate. But like you said, these are the lowest valuations we've seen in a long, long time on a lot of very high quality companies. So now's the time to buy. And then, over the next decade, I'm sure you'll see real estate back up at the top of the annual sector rankings several times, and everything will even out over the long term. So with that in mind, I'd rather buy things when they're cheap as opposed to when they're expensive. And so that's when I'll get to my stocking stuffer here. This pick might surprise some people. If you followed me on Seeking Alpha for a long, long time, and I know there's viewers that have, this is a company I've written some pretty bearish articles about in the past. I just bought shares. It's December 10th right now. So I bought shares 2 days ago on December 8th. Netflix. I've been a hater of this company for a long time. I didn't like I like the business model. I didn't like the valuation. It never made sense to me, paying 50, 60, 70 times for Netflix when you could buy Disney for 20 times. I was wrong. I'm happy to say it. Netflix has drastically outperformed all the other streaming competitors, and I look like a fool for not having bought this stock a decade ago when I wrote a bearish article on it. Now I own it. The stock has sold off massively in the last week or so because of this Warner Brothers acquisition that they announced. I love the move. If this goes through, and that's a big if, but if this deal goes through, if Netflix is able to pay, I think, $82 billion for Warner Brothers, they're going to pick up DC Comics, Harry Potter, Lord of the Rings, Mad Max, Mortal Kombat, Game of Thrones, Friends, classic animation like Looney Tunes and Scooby-Doo. The list goes on and on and on. So to me, this move, this Warner Brothers deal is what tipped the scales. I think this company quickly becomes like too big to fail in the media space. Their IP would be so strong, and they would have a really good studio, which is something Netflix lacks. Netflix makes some shows, some are good, some are not, etc. But they just sell other people's content. Now they would finally be able to make their own content in a major way, and that changes the thesis for me. So I recently bought some Netflix at $96 a share. They're way down. They were $135 a share not that long ago. So I like the discount I'm getting now. I think it's about 30 times forward. What do we got here? They're going to earn 325 next year. Yeah, so about 30 times forward. Expensive, but they're growing at 29%. So like I said, about a 1 peg ratio. I talk about that on the show all the time. I'm happy to pay high premiums for high growth rates as long as the peg is about 1.5. So that's where we're at now after this kind of antitrust sell-off. And I'm listing this as a potential Christmas stocking stuffer because I hope that by the 25th, this thing keeps falling, falls to $85, falls to $80, 75, etc. I will buy this in tranches as it goes down. Netflix is a free cash flow machine. I love the recurring business model, and I love them even in a recession. Like, you're going to cut out your coffees, maybe you're going to cut out, a lot of luxuries in your life. No one's cutting their Netflix subscriptions. Honestly, for $20 a month or whatever it is, that's about the best deal going as far as kind of entertainment value. So that's my stocking stuffer. I now own Netflix, and I hope by Christmas I bought a lot more at lower prices.
Nick, before you get to the call,
there we go. What do you got?
Great pick. I was surprised with the news that with Warner Brothers. However, I was not surprised to see my daughter, Lauren Thomas, Wall Street Journal, break that news.
Yep.
And
she's got her thumb on the pulse.
She is on top of the pulse. I just every day I open up the Wall Street Journal. I'm surprised if I don't see her on the top of the paper, above the fold, actually. But great. It was a great story, but with Lauren. Also, I want to say there's a real estate angle here because I'm going to be writing about this at Wide Moat Daily, hopefully maybe soon. But there's a real estate play. I mean, now you've got a monopoly on this real estate out in California. And so it's going to be interesting to kind of break down the real estate component and how much real estate Warner Brothers owns, they control in the movie industry. So I think that could be a really interesting angle. But I agree with you, Nick. It's a highly sustainable business model, probably one of the widest moats I've seen, in this kind of technology place. And I think everybody on Christmas Day most people are going to be sitting around watching a Netflix movie today, tomorrow, next week. They've got such a huge subscription business model. So they've done a great job. So Nick, good pick. And I cannot wait to hear about the coal. Look, as a kid, I'd always watch and read Charlie Brown books. I watch the movies with my children. I know Lauren, my oldest daughter, she loves Charlie Brown. Shout out to Lauren here again. But so anyway, Charlie Brown always hated to get coal in his stocking. So you're going to give us some coal here today, right?
Yeah, this is so, a coal obviously is what you hope not to find in your stocking. For me, from an investment standpoint, it's what I hope not to buy in 2026. And it's actually gold. I hope I don't find any gold in my stocking. And that, there's that, I'm sure our editors are going to put that at the top of the video. There's the statement. But here's the thing, gold's had a massive run in 2025. I get why, right? The money printing across the world, a lot of geopolitical uncertainty, fear of other countries dumping US bonds and having to replace them with something. Well, gold's the obvious answer. It's had a great year, but and I've been tempted to buy in. That's why I'm saying this. I'm going to use this video as a reminder to myself. Please do not buy gold next year, because you see anything go up and FOMO starts to creep in. Hey, I don't own any. Should I? What if it goes up another 40%, etc.? But like we've said at Wide Moat for years and years and years, the problem with gold is it doesn't do anything. It's a shiny metal. I like, I get it. I go into a jewelry store looking at watches or something for my wife, and all these glittery things. I get it. It's fun to look at. It's alluring. I kind of wish I did own some just so I could, flip the coins or something. But I do not want to be buying, gold buffaloes or golden eagles in 2026, because I would much rather be allocating all of my investment resources towards things like a Netflix that compound. No, Netflix doesn't pay a dividend like most of my holdings, but its earnings are growing at 25-30% a year. Gold's earnings don't grow at all. There are no earnings. It's just, I'm not going to call it a game of like, fool's gold, where it's just the price of what somebody else is going to pay. But at the end of the day, it doesn't do anything other than just maintain value. Stocks, on the other hand, increase value over time, and while protecting you from inflation. So I understand wanting inflation hedges. I do too, right? I do that with growing dividends. I pick companies that have dividends that are growing at a rate that's a lot faster than inflation for the most part. That's my inflation hedge, not gold. So yes, I'm tempted by the FOMO. Congratulations to all the gold bugs. 2025 was your year. And obviously I look silly not owning any, but I don't want to buy the top. Maybe if it goes down to 2,000 bucks an ounce or something, that's the time I'll buy the dip. But I don't want to chase this momentum. So as crazy as it sounds, gold is my coal for 2026. I know I'll be tempted to do it, but I really hope I avoid the temptation and just continue to buy blue chip stocks. So I think that wraps up our Christmas video. Thank you guys so much for spending time with us here on YouTube. If you're watching this today, now's the time, X out the screen, go back to your families, enjoy these precious moments. And Brad and I will see you next week on New Year's Day. So until then, Merry Christmas. Remember the reason for the season, remember your family, etc. And, we'll see you guys next week.
Hi, everyone. Thank you for watching today's episode of the Wide Moat Show. Please comment, like, and subscribe below, or go visit us at widemoatdaily.com. As always, happy SWAN, sleep well at night investing.